Picture this. Two people, same city, same job, same salary, $47,000 a year. One of them goes home every night and thinks about Thursday. Not because something exciting happens on Thursday, because Thursday is payday. And payday means the accounts reset just long enough to cover what's already gone. The other one goes home and thinks about nothing in particular. Maybe dinner, maybe a walk. The month doesn't feel like a countdown. Same income, completely different existence. The difference is not discipline. It's not intelligence. It's not even luck. It's one thing, and one thing only. One of them owes nothing to anyone. And here's what nobody tells you. The moment that becomes true for you, the rules of your financial life don't just improve, they fundamentally change. The game you were playing ceases to exist, and a different game begins. Most people never find out what that game looks like, because most people never get there. Let's talk about why. Debt in America, and across most of the developed world, is not a temporary inconvenience. It's infrastructure. The average American household carries around $96,000 in total debt. That includes mortgages, car loans, student loans, and credit cards. $96,000 sitting on the balance sheet of an ordinary family that is probably not thinking of themselves as carrying $96,000 in debt. They're just living their life, paying their minimums, getting by. Here's the number that matters more. The Federal Reserve estimates that the average household pays roughly 20% of its after-tax income directly toward debt service. Not toward things, not toward savings or investments or experiences, just towards servicing the cost of having borrowed the money to get those things in the first place. 20% gone before you do anything else. Now think about what that means over a lifetime. If you earn $50,000 a year from age 25 to 65, that's $2 million in total lifetime income. If 20% of that goes to debt service, you have just donated $400,000 to banks, lenders, and credit card companies. Quietly, automatically, monthly. This is the machinery most people are living inside without realizing it. And it's not malicious, it's just math. It's the math of borrowing money, which costs you time, which is the thing you cannot get back. Becoming completely debt-free means you exit that machinery entirely. And what happens then is stranger and more significant than most financial advice will ever tell you. Let's get specific about what actually changes mechanically when you owe nothing. First, your income gets bigger. Not because your employer suddenly becomes generous, but because you stop bleeding. If you were paying $1,000 a month in debt service, car note, credit cards, student loan, going to zero means you just found $12,000 a year that was already yours. No raise required, no side hustle, no luck. The money was always there. It was just leaving before you could touch it. Second, your risk profile collapses. This one is underrated. When you carry debt, your financial life runs on a certain baseline of anxiety. It has to, because debt has no patience. Miss a payment and the interest compounds. Miss two and your credit takes a hit. Miss enough and the collectors come. This means your income is not really yours, it's collateral. You need the job not because you want it, but because without it, the whole structure starts to crack. Debt-free, a job becomes something you do, not something you are terrified to lose. A layoff becomes an inconvenience instead of a catastrophe. This is a different psychological reality, and it changes every decision you make. What you'll tolerate at work, what risks you'll take, whether you'll quit something bad and wait for something better. Third, and this is the one people genuinely don't see coming, your savings rate transforms overnight. The average American savings rate hovers between 4 and 6% of income. Financial advisors say you should be saving 15 to 20%. Nobody can figure out how to bridge that gap. Here's one reason why. They're trying to save while also servicing debt. When the debt disappears, so does the gap. Suddenly, 15 or 20% is not heroic. It's just what's left after the normal bills. The same income that felt tight now feels different. Not rich, but different. Let's do the math that no one puts in the brochure. Say you're 30 years old. You've just paid off everything, house included. You're earning $60,000 a year. And let's say you can now save and invest 25% of your income, $15,000 a year, because you have no debt payments. At a historical average stock market return of roughly 7% annually, adjusted for inflation, that $15,000 per year for 35 years grows to approximately $2 million by the time you're 65. Now, run the same numbers for someone who spends those same 35 years servicing debt at 20% of their income. They're saving 10%, not 25%. The result, roughly $800,000. Still not bad, but it's a gap of $1.2 million, driven entirely by the debt service drag, not by income, not by investing skill, just by the monthly bleed. Here's the irony. The financial industry will spend enormous enormous energy trying to convince you that the path to wealth is about picking the right investments, choosing the right funds, optimizing your portfolio allocation. And yes, those things matter at the margin, but the single most powerful investment move available to a normal person in their 30s or 40s is not a hot stock tip. It's getting to zero, because from zero, everything compounds in your favor rather than against you. The banks understand this math extremely well. That's why they built an entire civilization around making it easy to borrow and socially normal to stay in debt. There's a version of this story that gets told on personal finance YouTube that goes something like this. Pay off your debt, feel amazing, drink green smoothies, live your best life, financial freedom, hustle, grind, #motivated. That version is exhausting and also not entirely honest. The reality of being debt-free is quieter than the influencers make it sound. It doesn't feel like winning a race. It feels like the race stopping. Suddenly, there's no scoreboard, no minimum payments, no utilization ratio to manage, no interest rate to renegotiate. The thing that used to create urgency every single month just stops being urgent. And some people find that disorienting at first, because a lot of modern financial anxiety is also what structures your decision-making. When you remove the threat, you have to consciously decide what you're optimizing for. And most people have never had to ask themselves that question in a low-stakes environment. Also worth saying, debt-free does not mean financially independent. It does not mean wealthy. It does not mean problems disappear. Medical emergencies happen. Cars break. Markets crash. The difference is that when those things happen, you are absorbing the shock with your resources instead of stacking new debt on top of existing debt. The hit lands on a solid surface instead of a system already under pressure. That's not glamorous, but it's the actual thing. Zoom out for a moment. What does it mean that most people never reach this state? In 2023, total consumer debt in the United States crossed $17 trillion. That number includes mortgages, auto loans, student loans, credit card balances. $17 trillion. For context, the entire GDP of the U.S. economy is roughly $27 trillion. Debt is not a personal failure at that scale. It's a structural feature. The economy requires borrowing. Growth requires borrowing. Entire sectors, banking, credit, insurance, are built on the interest payments of ordinary people running the debt treadmill indefinitely. This is not a conspiracy. It's incentive design. Banks make money when you carry balances. The government supports home ownership through mortgage deductions, which makes debt culturally normalized. Automakers finance their own cars, product, because it moves. Student loans fund an education system that costs too much. The system does not have a strong incentive to help you reach zero. It has a strong incentive to keep you serviced and manageable, which makes reaching zero quietly radical. Not in a flag-waving, movement-joining sense, just in the sense that you have removed yourself from a particular economic mechanism that was never designed to benefit you in the long run. Here's what I keep coming back to. The people who talk most loudly about financial freedom are usually either trying to sell you something, or they're at the very beginning of their journey and everything feels revelatory. The people who are actually there, actually at zero, tend to get quieter. Not because it's disappointing, but because the noise was always mostly about the debt, the stress, the calculations, the juggling, the background hum of owing people money. When it stops, you don't feel euphoric. You feel like you can hear yourself think. And then a different set of questions emerges. Not urgent ones, not crisis ones. Just, what do I actually want? What do I want to build? What risks am I willing to take now that I couldn't afford to take before? Those are better questions than most people get to ask in their financial lives. The uncomfortable part is this. The math has always been available. The path has always been visible. And yet, the average American dies with around $60,000 in outstanding debt, not because they didn't understand interest rates, but because the system is very good at making debt feel normal, manageable, and permanent. So the real question is not whether becoming debt-free changes everything. It does. The question is whether you believe it's actually possible for you, and what it might cost you to find out.